Hi, in this video I'm going to be talking about trading triggers and what they actually are and how to use them. So let's start off what a trading trigger actually is and isn't. Firstly, it's only part of a strategy, so it's not a strategy itself. It might be the trigger literally for that the okay for a strategy to go ahead, but the strategy should be built up of other factors. Now, amongst other things, this setup stroke filters for the strategy itself might include that price has to be in a particular area. It may have to have done something in particular. You might be spotting a strategy using a indicator, so the indicator may be in a certain position. So whatever's happening, that gives you the point of right, okay, I now need to look how to get into this trade. So that's the setup, as I say, stroke the filters that you need to get into it. At that point, we then look at the setup trigger itself. Now the trigger will give us a point of potential entry. So once we've seen the setup, we've got a trigger which will give us the potential entry. From there, we can calculate the amount of So we've got the nature of the risk that's involved, the amount of risk, so we can start looking then at the potential exit. So you have an exit in terms of your profit target and your stop loss. So all of these factors then come into play. So understanding the trigger fits well inside the overall strategy. It's effectively part of the strategy. Now, triggers don't necessarily always have to be a fixed trigger, and that's what I'm giving you some ideas of different types of triggers. It depends on the strategy. Some strategies, I showed one on a recent video which could have had a number of different strategies, so I thought the best, or triggers, so I'm going to show you a number of different triggers. In general terms, we can look at these setups, triggers, in terms of aggressive and conservative. There's sort of two groups. I'm going to show you each group and discuss each group as we go through the pros and cons of both, of course. So firstly, you've got the support and resistance type indicator, or I say indicators, triggers. Now, such a trigger might be when it first comes into support of a moving average. So, for example, down here where the moving average, the prices come into the moving average, and well, on this particular case, bounce. So that would be like, in this particular case, a support indicator. So it's pretty aggressive. You're buying as it hits the moving average itself. So that's a more aggressive method. Of course, the failure or the risk of that is it just runs through the moving average that you're looking at. However, if you're using this type of trigger, if you're looking for the first test of any moving average once price has moved through, this is quite an unusual case here, and probably had some sort of upward movement first, but generally when the price has initially first broken the moving average and come back to retest it, often that's its first real test and has the best chance of succeeding. Side of moving averages, then you've got like previous highs and lows. So just drag this over a little bit so you can see the price action, and you've got the high here, and then you could be selling into those highs, or there'll be people even in this shorter time flow. This is a 4-hourly chart. They'll be looking at these two highs here and will be selling into the highs. Obviously nice and successful at this particular point, but the risk, of course, just as with the moving averages, is you might be getting into what is seen for you a double top, such as down here, for example, and yet price is pushed on through. And again, here it may have just come up and looked a little like a double top at one stage, but yet it's run through. So there's the risk. Of course, again, a double top. I know a lot of people like triple tops and quad tops and bottoms, but realistically, the more times that you're actually knocking on the door of the upside or downside, the more chance it will actually break. The third trigger in this grouping would be the something, well, say such as you can have a number of different ones, but where you're looking at a Fibonacci retracement. So this hasn't just gone into the right area. Let's just do one from here. It's very random, I admit, but you're looking at a retracement, so you'd be buying into a 38 or a 50% retrace. And again, you can see the potential risk. If I was able to put it on the bottom here, let me just readjust that. So there you go, it's from the top to the bottom, so it makes a bit more sense. So you've got a high in, and you're just looking to buy for the continuation of the move from whatever your setup is. You're just looking for the trigger. Well, the trigger could have been the 23, the 38, the 50, and again, the risk in this particular case, the prices continue just to run through it. But of course, at times they work perfectly. Now, aside, of course, the other factors that can give you support and resistance, of course, are my favorite pivots. And you'll see here it gave resistance, a run into, and again, first tests always the best. Once it's tested, it's tested. Second test, more likely to go through. It's come retesting the other side. Whenever you take any of these types of moves, though, into support and resistance, you've got to be aware that there may be some slight follow through. If you're just literally expecting it to stop there and you're putting your stops too tight, you're more likely going to be stopped out quite frequently. Either way, this more aggressive method may be open to more types of stops. So the next group really in this aggressive method of triggering trades is indicator driven, effectively. So here it's really down to the indicators themselves, such as moving average crossovers, for example. So you'd be buying or selling on a crossover, a moving average. Now, a lot of people like these types of trades because generally, particularly on the bigger side of things, the risk, I guess, is slightly different in terms of, well, firstly, the moving average can uncross quite quickly. So if it flattens out, so if the market has become quite flat and you're looking for a trade, it's more likely then to run back the other way. So you get a crisscross effect. And possibly not a lot of profit in terms of it. Just looking for an example where it's sort of a bit flatter, but it's this market's being quite, oh, there we go. So you're just sort of getting it crossing one way, looking the short term going through. The long term would be a bullish trigger, and then again it's just crossed backwards. So that's the risk of that type of trigger. It's perfectly it works perfectly well for some people, and it works better when it's sort of, again, first cross after it's come through, pricing turning round. Sometimes you may look for it with price above or very close to the moving averages that you're using. So that's a moving average. Of course, there's the divergence type of trigger. Now, the difficulty with these divergence trades, the easy thing, look, there's a divergence between the low there, there's a higher low. So if you had reason to be looking for the long side, aside of just that, well, that could be your setup, your trigger then is where it's all about, and you'd be looking at buying at some point. Now the problem in terms of divergence is, of course, you can get these multiple, there's a better example back here, multiple divergences coming through, and each one of them failing because the trend is so strong. So that it has its risks. At the same time, and particularly in this more recent time here, it's given a reasonably good reversal pattern. So that's a divergence type. Again, you might look for something else, some support, some other support to be actually in the trade from this. Now, finally, I say finally, but finally, really, overbought, oversold signals. Just looking at the RSI, you've got an oversold signal here. Again, it's just a case of selling once it's closed on its oversold levels, possibly. The trouble with that, of course, is it can continue. It just pulls back a little bit and continues running up, or it just continues. A market can, like back here, where it's got pretty oversold here. Sorry, it's overbought up here, oversold, and it's continued to run in that for quite a few pips. So it's something you've really got to take into account there. So that is really the more aggressive type triggers. Let's have a look now at some conservative triggers. So conservative trigger points would be this type of method, such as where you're looking for a higher low. So if you're looking to buy into a market, you're waiting for a higher low to come through. So the trigger point would be the break of the prior high there when it's confirming the higher low. So that's a possible trigger point. And it's likewise on the downside. Let me just pop the pen on here so you can see. So there was your previous high. So you'd just literally be looking at the trigger would be on the break of the high there, which confirms this is a higher low. And markets in an upward range have higher lows and higher highs, and this is immediately putting in a new high, and it's a bullish trigger. Bearish trigger would be here up the top. Here you've got this low in here and this high, so this high is there, and then as you break the low, it compared to this high, you've got a lower high, and as it's breaking, it's giving you a lower low. So again, that would be a trigger. Now I'm looking at all of these on a 4-hourly time frame. It might be that you see the pattern on one time frame of whatever you're trading, and then come down the time frames for something which might just get you in earlier than the bigger time frames or the same time frames. Of course, you can be targeting on the bigger time frames. You might be just taking the entry on a shorter time frame. One simple method I use and quite a lot is reversal bars. So for example, I quite like flag trading. So if I get a bar which looks very similar to this one here, where you've got a reversal bar, you've got a flag, bit of a ugly sort of looking flag in this particular case. You've got a trend line, which you could use a trend line breakout, which is yet another method. But if you're looking at the reversal bar here, you've got a key reversal bar, bullish engulfing as well. So it's totally engulfed the previous body. It's also put a new high, a new low in, and a new high, which is a key reversal bar. And you're literally, the trigger is the break of the high of that, plus 1 or 2 pips. I always recommend. And I would recommend that even on these higher lows, that you just sort of look for a couple of pips over. Sometimes it just runs 1 pip, boom, and it rolls. So there's always a risk with any of this type of trading. So well, any trading, full stop. But of course, these are just that little bit more conservative, rather than sometimes just waiting for the trend break. If you've got a key reversal bar, it's showing the strength coming into the market. To be fair, patterns in the market such as flags have a decent and just drawing a trend line, a straightforward trend line over the top and trading the break. You've got a fixed stop on those as well. Generally, you might just need to check the stop is big enough, but you've generally got a fixed stop, and at the same time, and it's all set for you there. So it's just literally looking for the patterns as they come. The triangles, it's a triangle at the high, it's around near the highs here, which fouled actually into the high. Really, if you're using the trend line off the top there, you've got your triangle. The break of the low, again, a bit of common sense sometimes is just looking, actually let's just wait for it to break the 21 moving average as well. It's just a near point, so there's the trigger, bang. Of course, in this example here, there's the opportunity for a lower high. So whilst it's a sort of a bearish flag stroke triangle pattern, as the lower high comes in, it might be that you want to add into the trade. So it might be that you have an aggressive, more aggressive, conservative but aggressive trigger. But triggering and the more aggressive part of it, and then adding as it's breaking through. There's many ways of trading divergences, and I'll show you Wells Wilder's method of trading divergences as opposed to the more aggressive method I mentioned a short while ago, when you've got the divergence sitting there. Now you can wait for the indicator itself to give you a break over the prior high, for example. That's a method that some traders will use. So that's a version. It's slightly less aggressive than just seeing the divergence coming in. It's just waiting. You can use this with like some MACD or the RSI. Or you can wait for the price action, and I like price action. Most of the things I've been talking in these more conservative triggers are price driven, so you're looking at what the price is doing. Now Wells Wilder, his plan of how to trade divergences with the likes of Wilder's RSI, if I can put that on there, was the break. Oops, sorry, I put it on the wrong place. There we go. So it was the break of the high between the two lows in this particular case. So you've got the low, you've got the second low coming in, so giving us the divergence with the pattern here. And his principle was to take the break of the high. Now, of course, the downside of this is you're leaving a reasonable amount behind, but it will keep you out of quite a few trades. For example, coming back to the example I showed you here, where there was divergences running down here, but none of them would have triggered. There's a divergence between the low here and the low here, so you would have been looking for the break of this high over here. Sorry, badly drawn, but you're looking at the break there. Didn't happen. Second divergence comes in, high between the two of them somewhere around there, didn't really happen, got quite close, and then it's arguable it lost its divergence at that stage. But so you'd have just kept out of that particular trade. So that's a more conservative approach to trading the divergences. So it's not necessarily indicator driven. You can use the indicator, as I said, looking for when it breaks up. The actual price action is the absolute conservative method of getting in there as a trigger. And finally, I'm going to use, let's just switch markets here, because there's a brilliant example on the euro yen, if I can get it. And this is the classic. You've got a bit of a patch, a point here where there was plenty of supply previously, so the supply was coming through, and you end up with this range, a little bit of a range, and you can see I put this blue shaded area on it as a bit of a clue to where price was running. It's touched it, come up, touched it again, hit it again, hit it again, and eventually broken it. Now the more aggressive trader will take the break of the immediate break. More conservative trader will wait for the break and the retrace, and this is just literally come back, retraced, and off it's gone again. And yet again, they might actually, the very conservative one will wait until you've got a break of confirming a higher low even further. But of course, the downside of that is you're getting up here as opposed to down here, or even, well, down here. It's just looking for the test. Now, I mentioned earlier about using multiple time frames. On this here, you could use a multiple time frame and check to see what the options were as it sort of bounced off that. Well, it was nice, it's 21 moving average as well, but rather than just buying it into that 21 moving average and the highs, you might have just waited for a bit of a signal coming out of there. So for example, that was 12 o'clock yesterday, so if I come down to an hourly chart, we can see here 12 o'clock yesterday. So it's this bar, this area here, it found the support, came back. Well, then you've got this pretty bullish bar. You could wait for the second bar maybe even to get in there, and you've got a pivotal turn there coming through, which will get you in before the absolute high there. So it's a slightly certainly a more conservative approach than on the initial break or the retest down here. So it's just giving it the chance to show you its hand, basically. So there you go. There's a whole bundle of triggers. Do look at them. Sometimes some strategies fit better with one type of trigger than another. Do test them, do your back testing. When you're doing your back testing, you might consider different types of triggers. Remember, if you watched it, the video I did a couple of days ago on giving you a strategy, a pivot strategy, I was looking at the different methods of actually getting into effectively the same. So that was a strategy that took advantage of the pivot stats, looking at either targeting the S1 or the R1. This was a classic example today, actually. In this particular occasion, the same strategy, which is it must touch the pivot first before it hits the S1 or the R1. You can watch the video. I'll link it to this video. But one or the other, and then you're just looking for the break of the signal. Well, this was an outside bar, a bearish engulfing bar again, and it gave this sort of potential. For me, this one wasn't particularly great because the momentum was lost on the next bar. The 9 o'clock bar lost the momentum. It didn't break the lows there, so it wasn't the most aggressive bar, but it did eventually roll over. And of course, it was the Bank of Canada's results decision day today. So it would have made it a more risky trade either on that basis. I'm just looking. So this has hit the pivot here. It's then put a reversal opportunity to then trade that downwards. It would be potentially coming down the time frames even further. It did put a not quite a shooting star in there, but quite a reversal bar. Very, very simple. Now this is a sort of other type here. It's the breakthrough and retest. Now again, you can be selling that on the break of the prior low. It might be that on this move, on the earlier part of this bar down into the shorter time frames, you could be getting a trigger slightly earlier because you've got what's needed, the retest of the support. You can see here this was around about a support level with a couple of bars in that sort of range. It's come back, retested underneath and sold off. So there you go. That is my video on triggers. Hopefully you find it useful. Look at the different ones. If you've got other triggers that you want to discuss, do put them in the comments below. By the way, if you want to get more videos like this, do make sure you subscribe, and to be alerted, just hit the bell when you hit the little bell pattern when you hit subscribe, and it will give you the alerts of when a new video is being released. Trade carefully. Bye for now.